All right, there we go. Perfect. Of course, Bruce. Heck yeah. This is like I said, this is a topic that I think is important and again, so misunderstood. So let's get into it. One of the golden rules in retirement planning is this quote right here. Okay, and it's the first lens that we should be looking at every decision in retirement through. It's not about what you make, it's about what you keep. Okay, there are a lot of unknowns in retirement. Okay, I mean, many of you are going to spend 30 to potentially 40 years in retirement. And so during that time, a lot of stuff can change, right? Who knows what the economy is going to do in that time period? Who knows how investment markets are going to perform? Who knows what politics and how that's going to feed into different decisions that we make? So there's so many unknowns in retirement, but as the saying goes, the one thing that is known, or two things I should say, are death and taxes. And so taxes in retirement planning are the one guarantee, okay? You are going to owe taxes. And so this is the first lens that we should be viewing every decision we make in retirement through, okay? And so I see a lot of charts that look like the one on the screen right now. And maybe you guys have, maybe an advisor has shown you a similar chart. Maybe you've seen it looking at different financial blogs and whatnot. And it's basically trying to show the power of tax deferral. Okay, and what they do is they show $100,000 invested in a tax deferred account, so things like IRAs, 401ks, and then they show $100,000 invested in a taxable account. Now, it's widely understood that that taxable account can potentially be taxed each and every year. And so what this graph shows, and what so many advisors tell their clients, is if you're going to be taxed on your growth each and every year, it's going to minimize the amount, or it's going to curb the amount that you have in your account years from now. Okay, because you're paying taxes each and every year, and you're not able to defer it and pay those taxes on your time schedule. And so they'll show a graph like this to show you don't want to be putting more money in your taxable account. You want to be putting it in your 401k because you get a deduction and it grows tax deferred. And look, I mean, we can see the gap here. It's 100 grand turns into 466 grand versus 100 grand only turns into 306 grand. And so there are so many advisors and so many people in this industry that are just telling people to constantly put more money in tax deferred accounts. And I think this is a giant mistake. I would make a case that a taxable account, especially in retirement, can be your second most powerful retirement account, if not the first. The first, I would argue, would be like a Roth account, something that's never going to be taxed again. An IRA leads up the rear, okay? A tax-deferred account leads up the rear, mainly because of required minimum distributions. And every dollar you take is going to be taxed at full income rates, okay? So what I want to show is kind of examine this logic, okay? So in scenario one, we take $50,000. We invest it in the S&P 500, just basically the broad stock market, in a tax-deferred account. So that $50,000, we invest it in. Over some time period, it grows to $150,000, but now we're at retirement, okay? And we're wanting to withdraw $25,000 of income. Well, this person's in the 22% bracket, okay? So pretty simple. That $25,000 of extra income is they're going to owe $5,500 of additional taxes. Okay, so every dollar you take from your IRAs is taxed at ordinary income rates. Okay, now in this second scenario, let's say this was in a taxable account. Okay, and so that $50,000 in a taxable account, same growth period, it followed the same performance. 50,000 grew to 150,000. They withdraw $25,000 of income. But if that $50,000 grows to $150,000 over a period that's longer than a year, it's considered long-term capital gains. Okay, so that $25,000 of growth that was withdrawn, okay, has a preferential tax rate. Okay, so capital gains rates, the government will basically give people, investors, a benefit in order for it to invest in businesses, to help stimulate the economy. And so you essentially have a lower tax rate from that growth because of that. And so in this scenario, this person being in the 22% bracket, their capital gains rate would only be 15%. Okay, so withdrawing that $25,000, they'll owe $3,750 instead of $5,500. So this is an incredibly oversimplified example, but I think it's important to go through an oversimplified example in opposition to the last chart that we just saw, to show that a taxable account has the potential to offer tax savings. Now, again, as we go through this presentation, we'll see all the details that need to build in to this example. But right off the bat, we can see if we manage that taxable account properly, there is tax savings to be had. Okay. So my goal with this training is not only to show you how you can use a taxable account to your advantage, but also show you two concepts that I think are extremely powerful that can supercharge this and throw gas on this fire, if you will. And they're called tax gain and tax loss harvesting. And so in this period between when that money is invested and as it grows, there are tax savings that we can basically harvest throughout this time period and kind of soup up this example, if you will. Okay. So there are three core ways that you can save on taxes in retirement with a taxable account. The first one is something that we call income stacking. Okay. So basically, if you need income in retirement on top of Social Security, so let's say you need $50,000 of income on top of Social Security, you have retirement savings over here. What amounts should you withdraw from in that given year to not only curb your taxes this year, but also minimize taxes for years to come? Okay, this is a concept that we call income stacking, and it's kind of one that we've pioneered a decent amount of research on. Okay, the second one we're going to talk about is tax loss harvesting. We've covered it in past videos, but I really want to zero in today's video on this concept. And then the opposite side of tax loss harvesting is tax gain harvesting. So we'll cover that as well. So it's important, though, to remember that this training, especially, it's more important now than even a month ago. Okay. And I know Tony covered this on an election special, Wealth Wednesday, we did not too long ago. And he went through Joe Biden's tax plan. But his tax plan is now more on the table than ever before. With the Georgia elections and the Democrats looking like they have a unified government, everything in Joe Biden's tax plan is now essentially on the table. Now, again, Tony talked about how the majority of the extra tax implications will really only be on those that make more than $400,000 of income. And so for people in this group, I doubt we have anybody that's going to live in retirement on more than $400,000 of income. So it's not going to affect most of you. However, there is one part of this tax plan that's important for this discussion and will affect just about everybody. And that's the elimination of step up in basis. So prior to, or I guess right now, I should say, if you have a taxable account, let's use the example we had before. You had $50,000 that grew to $150,000. Okay. Now that extra $100,000 is gains. Okay. If you take it out for yourself, you will be taxed. However, there's kind of a cool loophole right now for passing that money on to the next generation. And so if you have that $150,000 with $100,000 worth of gains and you pass away, you pass that on to maybe a son or a daughter, they receive a step up in basis. So rather than having that same cost basis of $50,000, their new cost basis is $150,000. So they could withdraw that money after inheriting it with no tax. And so again, it is a loophole. I'm not going to comment on if the loophole makes sense. It definitely will affect everyone in this group, however. And so if this elimination of step up is enacted into law, the training, the stuff, tax loss harvesting, tax gain harvesting is going to become top of mind more than ever, because it's now going to be on you when passing money on to the next generation to make sure that you keep that tax liability as low as possible. Whether that mean it might be low, it might be cheaper overall in taxes to pass that liability on, but it also might be cheaper for you to take on that tax liability before you pass it on. So just a couple things to think about. Key terms to note as we go through this. The first one is what is a taxable account? For anybody that's not sure, it's basically any account that you are going to be taxed on those gains each and every year. So at the simplest level, a checking and savings account are taxable. Okay, the little interest that you get, you owe taxes on each and every year. But most people are going to have wealth in these taxable accounts in the form of an individual account or a brokerage account. For married couples, it might be a joint survivorship account. It might be a community property account. So it's basically any account that if you realize gains or losses, you will owe taxes on. So what do I mean by realized gains? Well, again, taking that example before, $50,000 grew into $150,000. Now, if they don't sell, they have what's called unrealized gains. And so they have $100,000 of tax liability and a $50,000 cost basis. Now that investment is going to continue to fluctuate, but it's all unrealized. Realized gains or losses come when you actually sell. So if that person sold that stock, $150,000 worth, they would realize $100,000 of gains. Okay. Now, if those gains were held for more than a year, those realized gains, it's long-term capital gains. If those realized gains were held from an investment held less than a year, they're short-term capital gains. So it's important, very important to distinct between these two, because long-term capital gains receive a preferential tax rate. Short-term capital gains are taxed at ordinary income rate. So at that point, if you're taking short-term gains on a continual basis, it basically eliminates all the tax savings that a taxable account can provide you. Okay, so let's talk about this first strategy, income stacking. Okay, what is income stacking and why does it matter? Well, as you go through retirement, different income streams will have different tax liabilities. So money coming from Social Security will be taxed differently than money coming from IRAs. Okay, taxable account withdrawals will be taxed differently than IRAs. Roth IRA withdrawals obviously are tax-free. So you have all these moving income streams that represent a different tax liability for your retirement. And so within those differing streams, we can build and stack income in a given way in order to keep your tax liability as low as possible. Okay, and order of withdrawals really matters, and we'll show that in a sec, but it's important to understand how income is stacked. So first of all, at the bottom, the foundation of your income is Social Security and pensions. So it's essentially forced income. So you don't really have the opportunity to choose whether that income comes or not. Annuity income would also be included in that. Okay, if you have $10,000 coming from Social Security, you're basically forced to take that $10,000 each and every year. I don't know why you wouldn't want to. So forced income is kind of at the bottom. From there, IRA withdrawals are stacked on top. Okay, that's essentially the second block, if you will. And then after that are capital gains. Okay, and it's important to realize how this income is stacked because it's going to matter in a sec. Okay. And so it's actually beneficial that capital gains are taxed last. It's the last block that gets stacked on for your income. Okay, here's why. On the left right now, I mean, for both of these charts, I should say, are for our 2021 tax charts for someone that's married filing jointly. Okay, on the left here, we see income tax rates. So that would be income from pensions, that would be income from IRAs. Social Security, once it starts becoming taxable, is taxed at income rates. Okay, and we can see over here that we have different periods that we will be in. Our tax rate steps up depending on how much we take as income. Okay, so you notice here from $0 to almost $20,000, you're taxed at 10%. From essentially 20,000 to 80,000, you're taxed at 12. From 80 to 172, you're taxed at 22%. Okay. But notice over here, capital gains tax rates. Okay, as you can see, as we said at the beginning, they're tax preferential. Okay, so if we're taking $80,000 from our IRA, for instance, we're going to be taxed at 10% and then 12%. But interestingly enough, if we take $80,000 from our taxable account, and those are all gains, okay, we're actually in a 0% tax bracket. Okay, and so right off the bat, we can see how we can start stacking our income in order to make sure that we have tax savings. Let's say that in a given year, let's say you're married filing jointly and you need, let's say, $40,000 of income. Okay, well, it might make sense, rather than being taxed at 10% and 12%, it might make sense to fill up IRA withdrawals up to $19,900 and then switch and take the rest of your income from capital gains tax rates, okay, because that would be at 0%. And so overall, you're just paying 10% on that first $19,900, and then you're tax-free after that. That's a very simple example. As we go through, like for instance, if we were at let's say $180,000 of income, if we're at $180,000 of taxable income and we take more money from our IRAs, we're going to owe 24%. If we take it from our taxable account, we'll owe 15%. And so regardless of where you're at for income, you can see how taking from a taxable account can lower that tax liability in a given year. So let's do a quick example. Pat has $1 million in retirement savings. He got half of it in an IRA, a tax deferred account. He's got half of it in a taxable account. Now he's single and he needs $60,000 of income. Okay. Now Social Security is only providing him $24,000. And so we see that there is a gap. Okay. So can Pat save on taxes through strategic income stacking? Okay, and the answer is yes. Okay, and I actually think I adjusted it. I just didn't adjust the slide. We're actually going to run it at him needing $65,000 of income. I forgot to change that last slide. So he needs $65,000 of income. Social Security is $24,000. That means he needs $41,000 from some other place. Okay, so in scenario one, we have him using his IRA. So his taxable Social Security income is going to come to $20,400. Okay, if you're not exactly sure how Social Security is fully taxed, we're not going to cover it in this video. We do have previous videos. Just comment below, and I'd be more than happy to tag you in that. So taxable income is $20,400. His IRA withdrawals then to meet his income need are going to be $41,000. Now we need to subtract out the standard deduction here. Now for him, because he's over 65, it's going to be $14,250. And so that leaves him with a taxable income of $47,150. Now again, Social Security, once it's taxable, as well as IRA withdrawals, are both taxed at ordinary income rates. Okay, so he's going to owe, down here we can see $6,121.50 worth of taxes. Okay, so what happens if he instead takes from a taxable account? Well, again, using the same numbers, just the $41,000 are coming from gains in his taxable account. We see same amount of Social Security, it's taxable, or the same amount of Social Security is taxable. Then we add in the $41,000 of capital gains income. Remember, it's taxed at a preferential rate, minus out the standard deduction. Again, his taxable income is going to be the same. However, the pieces of that taxable income are going to be taxed at different rates. So Social Security, once again, is taxed at income rates, and then the rest is taxed at long-term capital gains. And so rather than, and before we showed him owing $6,121, now he owes $1,627 in taxes. So we can start to see how powerful this can be. Now, again, this has to be weighed with future tax liabilities as well. But in this given year, he saves over $4,000 of taxes by stacking his income in a more efficient way. Okay. And so just kind of an explanation of this. So we take the Social Security income, minus out the standard deduction. Okay. We get $6,150 after that. So that's the income that will be subject to income tax. Okay. That'll be taxed at 10%. And then we have to plug the $41,000 of taxable gains into this capital gains tax rate. Okay. And so again, because of stacking, he already has $6,150. So the $41,000 will be on top of that. Okay. So basically he's going to have, call it $35,000 that is tax free. Okay. According to long-term rates. And then the rest is going to be taxed at 15%. So that's how you get to him owing significantly less in taxes, if that makes sense. Okay. And so let's go through this second strategy, tax loss harvesting. And again, we've covered this on past videos, but I want to focus a little bit more on it so it doesn't get lost by the wayside, because especially over this last year, 2020, it was such a powerful strategy. So quick overview of tax loss harvesting. No one aims to incur losses. Okay, that is not the point of tax loss harvesting. It's not like we want to go out and invest in companies we think are going to lose just for a tax savings. However, when we invest, okay, we have a taxable account and we pick 10 companies that we think are going to do well. Invariably, we're not always right. Okay, some things we're just bad timing on when we invest, and initially we see losses. And so is there any way that we can use those losses to our advantage? And the answer is yes. With strategic tax planning, you can actually turn a loss into a gain. And so that's what we're going to cover here. Just kind of give you an idea. Tax loss harvesting is a ton of research has been done by robo-advisors. So companies like Betterment and Wealthfront. And I'm a big critic against these robo-advisors, but there are some things they do well. Tax loss harvesting is one that they've at least put a lot of research into. And so Betterment, for instance, showed that between 2000 and 2013, tax loss harvesting added 0.77% per year in added returns. Okay. Now, again, that depends on your tax bracket, what your current tax rate is, but that is a compelling, there is growth to be had. Okay. With tax loss harvesting, there is added growth. And so it's important to understand the offsetting rules. Okay, so when you sell a fund or you sell an investment with a loss, okay, there is a certain order of offsetting that loss can have. Okay, so the very first thing is that losses offset gains. So let's say that in a given year, we sell a losing stock that we had, and we lost $10,000 on it. But then we also sold a winning position that we had, and we gained $10,000. Well, the first offsetting rule is those losses and gains will offset each other. Okay, so basically you'd have no tax liability in that case. Now, if you don't have gains to be offset, and it's important to also understand that short-term gains or short-term losses offset short-term gains first, and then long-term losses offset long-term gains. Okay. If you don't have gains and you still have a loss, then it can offset your income up to $3,000. So in that same example, let's say we didn't have the gain, but we had a $10,000 loss. Well, that $3,000 of that $10,000 loss can offset our income first. Then if we have more than $3,000 in a given year, we can carry it forward for years to come. Okay, so that's important to remember. It offsets losses offset gains first, then can offset income, then can be carried forward. So here's a kind of a quick snapshot, and we're going to go through a tax loss harvesting example, but here's a chart of the S&P 500, okay, and of 2020, and we notice here, January started off well, and then COVID hit, and everybody knows the market went spiraling downward. I think at the largest point, it was down 35%. Well, each of these losses in a given year represents an opportunity that we can tax loss harvest. And let me show you how. So Ted, at the beginning of the year, invests $15,000 in SPY, which is just a S&P 500 ETF. Now, obviously, he invested 15,000 over here. Ended up being poor timing. We can only know that in hindsight. So he's sitting down here with some significant losses. Well, during this time in March, while the market is down, what can Ted do? Well, here's an example of tax loss harvesting. What Ted can and should do is his S&P 500 ETF is down 20%. I'm not going to show you an example where he bottom ticks the bottom because that's basically impossible. It's not reasonable. So when it was down 20%, he said, okay, we're going to tax loss harvest. So he sells his S&P 500 ETF. So his $15,000 has lost $3,000. So because he only held this investment for 3 months at that point, it's a short-term loss. Now, for the year, we're going to assume he didn't have any other losses. So this short-term loss of $3,000 will offset his income. In this case, he's in the 22% bracket. So that's $3,000 of losses basically lowers his tax bill by $660. Now, for many of you, you're sitting here looking at, well, if he sells his S&P 500 fund, what happens if it bounces back? Okay, great. He takes a $3,000 loss and gets $660 back, but if it bounces back, he's missing out on all of that gain he could have. And you're 100% right. So with tax loss harvesting, what you want to do is you want to buy a similar fund, but what the IRS calls substantially different. Okay, so in this case, we're buying SCHX. All that is it's a Charles Schwab large cap fund, and it should track very closely to the S&P 500. Okay, so that same day, he sells the S&P 500 fund, but it instantly buys this fund in the same value. Okay, so not much happens. 1 year later, we're going to assume, and as we've seen, the market has recovered, but we're going to assume it recovers back to January 2020 levels. Okay, so March 2021, his investment went from 15,000 down to whatever it was, 11,000, back up to 15,000. Okay, and so Ted decides that he's going to sell this SCHX fund. Okay, now remember, his investment got back to break even, so now he has $3,000 of gains. It's long-term gains because it was held for more than a year. Okay, now remember, long-term gains are preferential, so that long-term gain, he's only going to owe $450 worth or in taxes. Okay, because he's owing 15%, he's in the 22%, but because it's capital gains, he only owes 15%. That means that he basically gets a tax credit during this time period of $210. So let's kind of review what he did. He sold at an offset income at higher rates, and then incurred his gains and paid income at lower rates. Okay, so despite him losing money, he had a tax savings. 210 divided by his initial investment is a 1.4% essentially tax gain that he took over this year. Now, if you have an advisor, kind of regardless almost of what they charge, that advisor just made their money. Okay, and this is how powerful tax loss harvesting can be. Now, we just did one investment, one quick example, but this can be done almost each and every year. Okay, and we can see that it can certainly provide a substantial return on investment, if you will. So there is one important rule that we need to be cognizant of, and it basically eliminates all the benefits of tax loss harvesting if we break this rule, and it's called the wash sale rule. And basically the wash sale rule is 30 days before and 30 days after. Let's go through the before example. So let's say you buy this S&P 500 fund and it has a loss within 30 days and you sell it within 30 days. That's a no-no, okay? That violates a wash sale rule. Basically what will happen is your cost basis will be adjusted down and you won't be able to take any tax benefit from it, okay? Likewise, let's say he was beyond 30 days when he sold this fund, but let's say that when he sold it, he bought back this S&P 500 fund right away the same day. Once again, that violates this wash sale rule. Why? Because 30 days after you sell that fund, you cannot buy it back. So this is basically the IRS saying, we don't want you to gain a tax benefit from tax loss harvesting. You have to buy what they would refer to as a substantially different fund. Now, that is a very loose terminology, okay? Because substantially different basically means that if it's a different investment company and it tracks a different index, that's substantially different enough. So in this example, we could have bought in this fund, we could have bought Dow Jones Industrial Average Fund, we could have bought a NASDAQ fund. We could just buy something that is going to perform very similar, but not the same as this S&P 500 fund, okay? And there's plenty out there, especially when you're talking about a broad index. And so again, if you violate this rule, what will happen is they'll eliminate any tax benefit you get and they'll readjust your cost basis down. So you kind of get hit on both sides. Definitely don't want to violate this rule. This is why tax loss harvesting can get tricky. I don't recommend people doing it on their own because of some of these wonky rules. So how can you build a tax lossable? I'm kind of making up a word there. Tax lossable portfolio. Well, things like mutual funds don't cater to taxable accounts whatsoever. And so what you want to do first is use exchange traded funds. Okay, that's what I would consider a good portfolio. Basically, exchange traded funds. Again, Tony did an ETF versus mutual fund training a while back, but exchange traded funds kind of operate like a stock in an index. You're investing essentially directly in that index. There isn't an active manager. Okay, that's why it caters to tax loss harvesting, because there isn't a manager that is kind of messing up this situation. Even better than that, though, would be directly investing in stocks, in companies. The reason being is because rather than owning the S&P 500, you could own, theoretically 500 of those companies individually, and that gives you 500 opportunities to tax loss harvest. So in a given year, there might be one stock that's down, 80% or something like that. Well, that's a great position to tax loss harvest. Now, I will say you're generally going to want a taxable account that's for sure larger than 250,000, maybe even 350,000 to really get a decent level of diversification over on direct indexing. So that would be the only thing. Exchange traded funds, you can go pretty small. I would say an account less than $25,000, you could tax loss harvest with ETFs. Okay. So how often should this be done? Well, here's a chart on the screen right now that shows the S&P 500 return in blue, and then shows the max loss, the max drawdown it had in a given year in green. So for example, let's zero in on 2015 here. We saw that the S&P 500 earned 1.38% that year, but at one point it was down as much as 12.5%. So we can see this across the last 2 decades. In every year, despite the market doing relatively well in most years, every year presents opportunities to tax loss harvest. 2020 was an incredible year for this. We had a ton of clients that realized essentially gains from tax loss harvesting during that March period. And since the market has bounced back, so we don't really have any issues on that front. So again, each year there represents an opportunity to tax loss harvest, almost any year that you look at. So again, just to kind of re-go over this, you want to realize your gains at low rates and offset losses, offset income at high rates. Okay, so we want to offset our income when we're in the 22, 24, 32, 35, 37% bracket. And then we want to realize our income over here. Okay, so just kind of a general rule of thumb. Let's go through tax gain harvesting. I will say tax loss harvesting can get a little tricky. I'm sure we're going to be running through more examples. Let me know if you had any questions on tax loss harvesting. Tax gain harvesting is a lot simpler. Okay, pretty straightforward. No wash sale rules apply when you have a gain. Okay, the reason being is because the only reason the wash sale rules are in effect is because the government doesn't want you taking a loss and then investing right back into that same fund in a short time period. They don't want you to have their tax gain. The IRS cares the most about getting their taxes. The reason there's no wash sale rules is because if you have a gain, wash sale rules when tax gain harvesting, is because when you have a gain and you realize it, well, the government gets theirs. They want to get their taxes. And so there aren't any rules on that front. Kind of a golden rule of this, and there's a small little asterisk here, but don't let a 0% tax bracket go unfilled. Okay, we'll talk about why the asterisk is there in a sec, but again, tax gain harvesting, given your situation, can be just as powerful as tax loss harvesting. But remember the offsetting rules. Okay, losses will offset the gains first. Okay, you'll see why that matters in a second. But here's basically what tax gain harvesting is. These 0% brackets here, you can see for a single filer and for a married filer. Let's say that you're taxable and you're married, and your taxable income comes in at $40,000 for a given year in retirement. Okay. Now we can see here that you might not need more income, or you might not need additional money from an income standpoint, but it might make sense to continue to raise your taxable income for this exact reason. Okay. Let's say that that person who has $40,000 of taxable income in this year also has a taxable account that has some long-term gains in it. Well, they could easily just, pay the taxes they owe on that $40,000 and move on to the next year, but they'd be missing out on an opportunity. As we can see here, at $40,000 of taxable income, they have essentially an additional $40,800 that they could harvest gains from their taxable account and pay 0% in taxes. Okay, now they don't need to take that money as income. It's basically just resetting their cost basis. So let's say that they had a stock that they initially invested $60,000 in, and now it's worth $100,000. Okay, well, if they sell it in another year when their taxable income is higher, they might end up owing taxes on that $40,000 gain. However, in this year, they could sell that fund, buy it right back immediately. What that would do is they would realize the $40,000 of gains. However, it would be in the 0% capital gains rate, and so they won't owe any additional taxes on it. Okay, and their cost basis would adjust from $60,000 up to $100,000. Okay, so now down the line, if that $100,000 grew to $120,000, they would only owe taxes on that $20,000 in the future. So they're resetting their cost basis and basically eliminating taxes out of there. Let's go through another example. Let's say you have a single filer, $30,000 of taxable income. They have a taxable account. Well, how much can they tax gain harvest in a year? Well, $30,000, upper boundary is $40,000, and so they can tax gain harvest an extra $10,000. Okay, so again, I know we had a question when we submitted that Q&A that you guys could submit a bunch of different questions. We got a ton of responses, especially on taxable accounts. One of the questions was, what are the boundaries for tax gain harvesting? Well, in 2021, if you want to be in the 0% bracket, it's $40,400 for a single filer, and it's $80,800 for a married filing jointly. Okay. And so it still might make sense to gain harvest at different rates, depending, again, on your tax situation. So for instance, if you were in a very high bracket, it still might make sense to harvest at 15%. But generally speaking, when people talk about tax gain harvesting, they're just talking about harvesting in this 0% zone. Okay, so I will say tax gain harvesters, beware. And you want to be aware of the other liabilities that you potentially have in retirement. So the Social Security tax trap's a big one. If you gain harvest and you're on Social Security, every dollar worth of gains that you harvest is going to move a percentage of your Social Security benefit into becoming taxed potentially. Okay, so you might harvest a dollar worth of gain, and that might you might not owe any taxes on the capital gains side of that dollar, but that dollar might move 85 cents of your Social Security benefit into becoming taxable. which would be taxed at income rates. So if that 85 cents is taxed at 12%, that gain harvesting creates a tax liability. Now, again, it might still be worth taking that tax liability, but you need to make sure you're calculating that in. Another big one is Obamacare subsidies. Okay, if you're trying to peg your income and report a low level, and you want to gain harvest, and that gain harvesting adds $20,000 of extra income, you might not owe any taxes on that. But when you report that income to Obamacare, essentially, it might cause you to have a higher. It might eliminate some of your subsidy. You might have a higher monthly premium. So selling $20,000 worth of stock, you might owe 0% on that stock. But if it raises your healthcare premiums by $1,000 a month, obviously we're paying a $12,000 tax on that $20,000 harvest, if you will. Obviously, that would never make sense. Okay. The other thing to note is IRA account liabilities in the future. It might not make sense to tax gain harvest if you have big tax deferred accounts. Okay. The reason being is because it might make more sense to do a Roth conversion instead of harvesting gains. Okay. It's great to harvest gains if you're, let's say you're 65 and you have big IRA balances. It might look great in that year to harvest a gain and pay 0 in taxes. But once you turn 72, those RMDs can be pretty overwhelming and pretty scary. Okay. It can jump you up an additional tax bracket, if not 2. That represents a larger liability than the gain harvest that we could have taken later on. Okay. And so it might make sense instead to do a Roth conversion in that year, even though you might be paying a little bit more in taxes rather than tax gain harvesting. So why then are so many people negative on taxable investing? And you can see just kind of by my energy that I nerd out on this taxable account stuff. So why do so many people have a negative connotation against it? And the reason being is, one, because most people don't understand how to use a taxable account efficiently. And number 2, they don't have control. So from an advisor standpoint, the reason so many advisors tell people to shell money away in an IRA is just simplicity. Okay. If you add in taxes, it's another variable that they need to think about. Again, most people, I guess, want easier life, easier career. So if money's in an IRA, we can buy and sell left and right, not worry about taxes. If it's in a taxable account, we need to be very careful on how that's managed. The reason so many retirees don't like a taxable account is because they're mismanaged. Okay, so if you have money in a CD or a bond and that's spitting out $3,000 of interest, well, whether you want it or not, that's adding $3,000 to your taxable income in a given year. Interest from savings, checking, CDs, bonds, dividends are all taxed in that given year. So how can you gain control in a taxable account? First off, don't own mutual funds. Why? Well, because when you buy into a mutual fund, you're basically buying into a structure where you have a fund manager that manages your investments. Okay. And they get to decide what taxes are incurred in a given year and what aren't. So let's say that Tony owns a mutual fund. He doesn't, but let's say that he does. Okay. He has $10,000 in this mutual fund. In a given year, do you think that fund manager is worrying about Tony's tax liability? No, of course not. They're worried about growing that money and worried about getting their fee. They're not worried about your tax liability. So what happens with mutual funds is they spit off sometimes short-term capital gains. They spit out long-term capital gains. They spit out dividends. Okay. Another one is don't own bond funds in a taxable account. Again, with mutual funds and bonds, if you want to own these funds, own them in your IRA. That's totally fine. Don't own them in your taxable account. Why? Interest is taxed each and every year. So that's going to spit out interest that you owe taxes on. Well, depending on where you are in retirement, that can be very costly, especially on Obamacare, especially with the Social Security tax trap. Okay. Another big one is avoid dividend stocks. Again, a lot of people love dividend stocks for retirees. That's fantastic. Okay. They're stable. But Don't own them in a taxable account. Own them in your IRA. Own them in your Roth. Okay. Why? Because those dividends are basically forced distributions. If you have a stock that has a 3% dividend, you have $100,000 in that stock. Well, that's forcing you to take $3,000 of income in a given year. It's messing up your tax situation. It's losing you control. So everything negative about a taxable account can be reversed by managing it better. And so in summary, again, I think and I believe a taxable account is your second, if not your most valuable and powerful retirement account. Okay, the reason being is for everything we've talked about thus far. If you manage it properly and you make sure you stay in the driver's seat and in control of what income you take in what year, a taxable account can be powerful. Okay, rather than being taxed at 22, you can be taxed at 15. Rather than being taxed at 12 and 10, you can be taxed at 0. Okay, well, taxed at 0, it's basically working like a Roth. Okay, most advisors will steer you away. Why? Basically just complexity. Now, here at Safeguard, I will tell you, we love taxable accounts. Again, I think it's just because we nerd out a little bit on it. And so if you have an advisor that's steering you away, that's trying to invest you in a mutual fund in your taxable account, or is trying to tell you to get money out of that taxable account and put it in IRAs, I want you to run, not walk towards the door. Okay. It should be sending out red flags left and right. Okay. Again, a taxable account can be powerful if used to your advantage. They're just not going to help you use it to your advantage. Taxable strategies that we've gone over, like tax loss harvesting, can be complex for sure. They take time, but as we can see, they are completely worth it. And again, always remember, it's not about what you make. Okay. It's about what you keep. It's great that you might earn 10% on your investments in a given year, but if you owe 4% to taxes, you really made 6%. Versus if you can invest in a lower growth vehicle, like let's say it only got 8% and you don't pay anything in taxes, well, 8's better than 6 in that example. Okay. So we need to make sure we're looking at everything after taxes. Okay. And so hopefully this was educational. I'm not seeing too many questions. So let me know as you're watching the replay if you have additional questions. I'll make sure that I answer them afterwards. Hopefully this was educational, kind of dove a little bit deeper into a taxable account and showed you just how powerful it can be when building your retirement into in tax efficient income stream. So always remember, you don't need more money. You need a better plan. You need to use taxable accounts to your advantage. You need to use income stacking, tax loss harvesting, and tax gain harvesting. Thanks for watching, everyone. Have a great rest of the day.